Hi, I'm Richard Vague with Tychos. It's January, so a good time to check in and compare the performance of stock markets around the globe. And for us, that means looking at the stock market indexes from the big 7 countries, which together constitute 61% of global GDP. To start, we should note that the U.S. stock market towers over the others, both in dollar value and as a percent to GDP, meaning the U.S. market remains the preferred global market for issuing stock. But let's look at the stock market performance of each of these since the end of the pandemic, which we can set somewhat arbitrarily as 12/31/22, taking the view that the pandemic lasted for most of the years 2020, 2021, and 2022. The biggest surprise is China, which is the only market that has declined in value since the beginning of 2023 and is now down 11% since that time. But maybe we shouldn't be surprised since we've documented well all the troubles that economy is now having. China's government is beginning to show concern and intervene, as reported by the Financial Times. Quote, Chinese authorities have in recent days told some institutional investors not to sell stocks as regulators face renewed pressure to stabilize share prices following the steep decline in the first weeks of the new year. Since October, market regulators have been providing private instructions known as, quote, window guidance, end quote, to some investors, which prevents them from being net sellers of equities on certain days. Such restrictions on selling helped to spur a rebound of about 3% for the benchmark CSI 300 stock index in the final week of 2023, traders said. But as the curbs on some smaller mutual funds and on brokers were eased in the new year, the index completely reversed those gains and is down more than 4% this month. Beijing has now reimposed such restrictions on securities companies, large institutional investors in China that both act as brokers and have proprietary trading arms, according to the traders and investment managers at 3 different financial institutions. The investors and traders also said that the change of direction by regulators, the latest in a series of U-turns, was distorting the market and undermining broader confidence, end quote. So you can see China has all sorts of troubles. The other 6 stock markets are up nicely, and the biggest positive surprise is Japan, where the Nikkei index is up 28%. As we covered last week, Japan's GDP growth is among the best in the world at the moment, in no small part because it has refrained from the massive interest rate increases engineered in most other economies. The U.S. is also up nicely, showing a 24% gain during this period. What we are showing you here is the trend, but what we need to also show is how high prices are in each of these markets compared to corporate earnings. That is captured in the market-wide price-to-earnings multiple, known as the PE ratio. The higher that ratio is, the more expensive that stock market is. Here we see the PE ratios for each of these 7 markets. Not surprisingly, Japan's is the most expensive at a PE of 29 times, and China is among the least expensive at 12.4 times. And the U.S. S&P index is somewhere in the middle at 22 times. Now, that may not mean that China's stock market is a bargain, since understanding the PE ratio is just the starting point for understanding the value of a given stock market. In fact, some analysts believe that China's corporate earnings are poised for a further decline, and if that's the case, we should not consider that market undervalued. But as always, with any stock market, you never know. That's it for this week. Thanks.